US inflation remains elevated above the Fed's 2% target, casting doubts on a potential rate cut in December. Meanwhile, Eurozone inflation appears ready to surpass the ECB's target, although underlying cost pressures are easing. Since Donald Trump's election victory, US and European markets have shown significant divergence in areas like yields and exchange rate. Hi, I'm Jun, a researcher with Dxpert. Global inflation is finally losing steam. Bloomberg Economics predicts the GDP-weighted average will slide from its 6.8% peak in Q2 2024 to 5.3% by Q4 2024 and further down to 3.2% in Q4 2025. Advanced economies are on a steady path towards calmer inflation waters, with rates expected to dip to 2.3% by year-end. Quite a drop from 3.1% at the close of 2023 and a whopping 7.8% in 2022. By next year, most advanced economies are on track to hit that coveted 2% inflation sweet spot, perfectly aligned with central banks' target. Now, let's dive into the action in the currency markets. Monetary policy continues to dominate market dynamics. Following the US elections on November 5th, 10-year Treasury yields spiked by more than 15 basis points within a week, but have since leveled off. This fluctuation highlights shifting expectations for Fed policy, underscored by Jerome Powell's evolving tone, as well as robust US economic demand and tariff concerns. Despite this, supply-side pressures have kept yields, indicating that traders are not pricing in significant inflationary effects from potential tariffs under the new administration. Inflation swaps further suggest that market participants anticipate a slight easing of price pressure over the long term. The FOMC describes the labor market as solid, though several members acknowledge challenges in interpreting underlying trends due to factors like immigration, data revisions, natural disasters, and labor strikes. They highlighted downside risks to employment, including weaker global growth, escalating geopolitical tensions, tighter financial conditions, and a sharp asset price correction. Nonetheless, many participants believe the likelihood of a sharp labor market downturn has lessened since September, though some still view the risk as elevated. The consensus among FOMC members is that risks to their objective are roughly balanced, supporting a gradual move towards a neutral policy stance. However, uncertainties around the neutral interest rate complicates evaluation of the current policy's restrictiveness, emphasizing the need for a cautious approach. This reaffirms my long-standing view that the final leg of the journey to return inflation to target will be the hardest, requiring further economic softening to achieve it. Shifting our focus to Europe, since US election, the euro has been on a downward spiral, shedding more than 4% of its value. About half of that drop stems from strong US macroeconomic data, with the rest fueled by expectations of further ECB rate cuts and disappointing Eurozone economic indicators. It's clear that monetary policy is still pulling the strings. Euro inflation briefly returned to the ECB's 2% target in October, buoyed by rising energy and food costs. But the disinflationary streak hit pause, and headline inflation is set to inch higher in the coming months due to lingering base effect. However, the bigger picture reveals a cooling trend where services inflation is losing steam and wage growth is slowing. With inflation nearing target and the economy faltering, the ECB seems poised to cut rates in December and likely to continue easing through 2025. Meanwhile, Germany's HICP inflation climbed to 2.4% year-on-year in October, up from 1.8% in September, thanks to spiking road fuel and food prices. And the inflationary hit isn't entirely out. Base effects in transportation could push it slightly higher in the final months of 2024. Still, the outlook for 2025 is much cooler, with inflation expected to dip below 2% as energy and services prices ease. The euro's trouble deepened on November 22 as weak PMI data triggered fresh bets on aggressive ECB easing. Nonetheless, hope flickers on the horizon as speculation grows that the Fed might take a softer tone, giving the euro a chance to claw back some ground. For now, the euro finds itself in a delicate tug-of-war between shaky Eurozone fundamentals and evolving US monetary policy expectations. On the euro 4-hour chart, a textbook inverted head and shoulders reversal pattern has emerged, hinting at a potential bullish comeback. The neckline connecting the dips between the peaks served as the battleground between bulls and bears. A decisive breakout above this line could pave the way for a rally towards targets like 1.06 and 1.07, aligning with Bloomberg forecasts and important resistance levels. But If the price fails to hold above the neckline, the euro may stumble or settle into a sideways drift, so you could keep an eye on the price action for clues. Thanks for tuning in. I hope you found today's video insightful. Everything I've shared comes from a mix of research and my own perspective. Remember, when it comes to trading or investing, always do your own homework and stay aware of the risk. If you enjoyed this video and found it helpful, please subscribe, share, and hit the like button. You can quickly access to all our channels by scanning the QR code. Take care, and I'll catch you in the next episode.